Financial reporting. We have left with the three small chapters. Chapter 20, 21, and 23. 23 is not a chapter. What we will discuss. So chapter 20, chapter 21, we need to discuss. These are leading to consolidation. But regarding chapter 20, we know a little bit. So probably this will be our last class. After this, there will be no formal class. I'll share some practice question video, probably on Monday. And there will be no topic left. So, consolidation, we have done. Balance sheet, profit and loss, subsidiary. If a company is having investment in other company between 1% to 20%, that we will record as a simple investment under non-current assets. If it is short-term, current assets. If investment is between 21% to 50%, that we will record as associate. And if investment is between 51% to 100%, that we will record as subsidiary. Are you with me? This thing is not written anywhere. This criteria we set to see whether it is a subsidiary, whether it is associate or simple investment. It is not written in any of the accounting standard. As per accounting standard, when you are having control over any of the investee company, that will be your subsidiary. What does control? We learned. You are changing their revenue, profit, you are receiving major part of revenue, profit. So control. Obviously, control will become when you are having more than 50% holding. As associate, if you are having significant influence, if you are having significant influence in any of the investee company, that will be your associate. If you are having significant influence in any of the company, you will be having it as associate. What does mean by significant influence? Significant influence means involvement in decision making of investee company. Influencing the decision of investee company. Obviously, when you can influence, when you're having a little bit high shareholding. Or significant influence happen if you are performing significant transaction with each other. Significant transactions with each other. Like a company is a total revenue is say 10 million. Out of that 10 million, if suppose 8 million is associated with your business. So being a major influencer of their business, you can influence their decision making. You can call it associate if you are having investment in that company. What does mean by significant influence? Involvement in decision making, influencing decision of that investee company, or performing significant transaction with each other. But from calculation point of view, numeric point of view, we'll see if our investment, if we have acquired any other company above 21 but below 50%, so that we will call it associate. But apart from investment, there will should be involvement in the decision making of investing company as well. In consolidation, we need to consolidate subsidiary results. Balance sheet item we need to consolidate, profit and loss accounting, our item we need to consolidate mean add. Relating to associate, we don't need to consolidate. Relating to associate, we don't need to consolidate. Relating to associate, what we need to record, we need to record associate as non-current assets. We need to record associate as non-current asset. Profit portion under profit and loss account as income, the income from associate, that will be called income from associate. And we need to add profit from associate in consolidated retained earnings. Associate where consolidated retained earnings. In these three accounting we need to do regarding associate. Now this topic, this chapter can be tested in our exam paper. We did one question relating to consolidation from the kit. Argent. In that question, there was involvement of associate. So as a consolidation question along with subsidiary, might be parent companies are having investment in associate, so that can be tested. Or small MCQs can be tested from this topic. So we need to make three accounting relating to associate. We need to record associate as non-current assets in consolidated statement of financial position. We need to include profit part of associate in consolidated profit and loss account as other income. And we need to add profit part of associate in consolidated retained earnings. How this asset can be calculated. How this asset can be calculated. This asset value can be calculated. First, we need to check what is our cost of investment. I mean, what is our investment in associate? In that investment, we need to add what? Associate profit portion. Profit portion of associate mean associate generated profit during the year 100,000. Your investment is 30,000. What is your portion according to your percentage? So that will be added. And this profit will be recorded under P&L as well. Whatever the profit associate generated after investment during the year, so that part of profit will be added to the asset as well as will be recorded as the income in P&L. From this, we need to deduct if there is any impairment of associate investment. If there is any impairment of associate investment that we need to deduct. Especially from asset, if we are recording as a asset, so we need to check if there is any impairment, we need to deduct from asset cost. And from this, we need to deduct unrealized profit part. If there is inter-transaction between parent and associate, and those transactions have been performed on using selling price. So we need to identify how much inventory is unsold at the year end. We need to calculate unrealized profit. So we need to deduct unrealized profit part from this associate asset if parent sold to associate only. If associate sold goods to parent, then this will not be deducted from asset. If a parent sold to associate, we will deduct unrealized profit part from the value of asset. Then this asset value we will record as associate in consolidated statement of financial position, the non-current assets. Can you understand this? How the asset value of associate that is will be recorded in a consolidated statement of financial position will be calculated. Cost of investment, any profit made by associate, so parent company share from that profit will be added. If there is any impairment that is understood, will be deducted from the asset cost. And if parent company sold any goods to associate, so that unrealized profit part we need to deduct from asset. If associate sold goods to parent, that will not be deducted from here. If associate sold goods to parent, then unrealized profit will be deducted from inventory in consolidated statement of financial position. Because where that inventory is, if associate sold to parent company, where that inventory is in parent company. And in consolidation, we include all the results of parent company. So in that case, unrealized profit part will be deducted from inventory, where in consolidated statement of financial position. Can you understand this? In case parent company sold goods to associate, unrealized profit part will be deducted from the asset investment. But if associate sold goods to parent company, in that case, we don't need to deduct unrealized profit from the cost of investment. We will deduct from inventory in consolidated statement of financial position, because that inventory has moved towards the parent, where it is in parent financial statements. From that inventory, we need to deduct. So, but that will be included in associate financial statements. So from that, by taking subsidiary profit, parent company will take. And then by removing from there, that will be net out. In consolidation, unrealized profit part should not be there. In consolidation, automatically that will be cancelled out. So in case of associate, how asset value can be calculated, cost of investment, we need to add what? Associate profit part, profit share. And if there is any impairment on investment, that will be deducted. And in case of any intergroup transaction between parents and subsidiary and parent sold to associate, parent and associate and parent sold to associate, then unrealized profit part we need to deduct from liability calculation. Liability means consolidated retained earnings. Relating to associate, what should be accounting? So first we need to record parent company retained earnings. That we record 100%. In that we will add what? The same thing. Profit share of associate according to their percentage. We will deduct, if any, impairment of associate investment. We will deduct unrealized profit part relating to intergroup transaction. Either parent sold to associate or associate sold to parent. In both cases, we need to deduct unrealized profit part from retained. From asset, we need to deduct unrealized profit part only if a parent sold to associate. But from retained earning, we need to deduct unrealized profit part whosoever have sold, but there are intergroup transaction between parent and associate. So while calculating consolidated retained earning, we need to deduct that. Obviously, along with that, we need to add the subsidiary reserves. Then we will be able to calculate the complete consolidated retained earnings. But regarding associate, we need to add profit part of associate. If there is any impairment of associate investment, that we will deduct. And if there is any intergroup transaction between parent and associate, so unrealized profit part will be deducted from retained earning in either of the case. But from asset will only be deducted when parent sold goods to associate. Can you understand this? If you can understand this chapter completely. And this calculation is called equity method of associate calculation. What does it call? Equity method of associate. Only this method.
Okay.
Only this method. So what we need to do in case of associate, we need to record non-current asset instead of investment. We will record it as investment in associate. But that value will be calculated using cost of investment plus associate profit share. The question we covered in previous class, Dargent, we performed this calculation only. Investment plus profit part. There was no impairment and there was no intergroup transaction between parent and associate. But if there is impairment, we need to deduct from the asset. If there is intergroup transactions and parents sold to associate, so unrealized profit will be eliminated from asset. Then relating to associate, we adjusted in target profit share of associate. If there is any impairment, we will deduct. And if there is any unrealized profit part relating to intergroup transaction between parent and associate, so we need to deduct either parent sold to subsidiary, associate, or associate sold to parent. Obviously, while calculating consolidated retained earning, we need to attach then subsidiary results, its share, its goodwill impairment, if there is any. Yeah, we can do like that. We can perform like first we can make working of subsidiary total and then we can make working of, because all these figure will be added with each other.
Sir, you when associate sells to
Parent.
do you subtract in
Then we need to deduct unrealized profit part from inventory in consolidation
yeah.
and should be deducted from retained earning as well.
How about cost of sales?
Huh?
Cost of sales.
Ultimately, closing inventory will go into cost of sales. So from profit and loss account, automatically that will be added to there.
Okay.
In unrealized profit part, just like we do with subsidiary, we add to cost of sale, we deduct from inventory. In consolidation, we current asset. The same way we will add to cost of sale in P&L and we will deduct from inventory in case associate sold to parent.
So both ways.
Both ways. Okay, let's move towards this chapter. Let's study. Associate an entity over which the investor has significant influence. Significant influence is the power to participate in the financial and operating policy decision, mean involvement in the decision, influencing the decision of the investee, but is not control or joint control. Because if there is control, that is subsidiary. Significant influence is assumed with our shareholding between 20 to 50%. Principles of equity accounting and reasoning behind it. Equity accounting is a method of accounting whereby the investment is initially recorded at cost and adjusted thereafter for the post-acquisition change in investors' share of net assets of the associate. I mean, first we will record cost of investment, but if there is any profit generated in associate, so our part will be added to that asset cost. The effect of this is that the consolidated statement of financial position include 100% of the assets and liabilities of the parent and the subsidiary company on a line by line basis. An investment in associate line with the non-current assets, which includes the cost of investment plus the group share, no line by line consolidation. For associate. I mean, associate non-current assets, current liabilities, we will not add with each other. Only subsidiary results will be added. The consolidated statement of profit or loss include 100% of the income and expenses of the parent subsidiary company on a line by line basis. Single line share of profit of associate, which include the group share of any associate, mean only profit part of associate will be recorded in P&L. No line by line consolidation of all the income and expenses. Can you understand this? Equity method. Leave it. So how asset value can be calculated? Cost of investment. In that we need to add share of associate post equity profit, less impairment and less PUP, provision for unrealized profit, where parent sells to associate only. The group share of associate post acquisition profit or loss, the impairment of associate and PUP will also be included in the group retained earning calculation. Mean these things will also be adjusted with consolidated retained earning as well. And normally in consolidation question, we perform some working. First working is relating to group structure. In that group structure, while defining group structure of a subsidiary, we will define the group structure of associate as well. And next working, we calculate net assets of subsidiary. So there will be no effect of associate. This working is not for associate. Then we calculate goodwill. So there will be no effect of associate. Because goodwill is relating to what? Subsidiary. Relating to associate, we record investment in associate. Instead of subsidiary, we don't record investment, we record goodwill. In non-controlling interest, there is no effect of associate because non-controlling interest is relating to subsidiary. And next working group retained earning, yes, there will be effect. Mean we will record parent company retained earning 100%. In that, we add subsidiary share. We will add associate profit share. Obviously, if there is any impairment of a subsidiary, so parent company percentage part will be deducted. And if there is any impairment of associate, that will be deducted. Any unrealized profit part relating to subsidiary, that will be deducted. And any unrealized profit part relating to associate, that will also be deducted. Like this, we will calculate group retained earning, consolidated retained earnings. And for investment in associate, we need to perform this extra working. Mean how the value of associate asset will be calculated. So cost of investment, in that we need to add profit share, deduct any impairment and deduct unrealized profit if parent sell goods to associate only. Otherwise, this will not be deducted. Are you with me? So let's move towards a small question. Chapter finish. Nothing more left. Trading with associate, there will be unrealized profit part. If parent sold to subsidiary, we will deduct from asset, non-current assets. But in either case, whoever sold to each other, we should deduct from retained earnings. Question number 6. Number 1, please. Which of the following are likely to be accounted for as an associate in the consolidated financial statements of TN parent? It's not control, it's significant influence. If there is control, that will be subsidiary, not associate. Option A, B, C, D. What is number one? A 25% shareholding in ZT. TN parent can appoint a director to the board. There are 4 directors on the board in total. None have control. Means there is no subsidiary. Obviously, if they can appoint director, they are influencing decision making, they are involved in decision making. So this is associate. Number two, a 25% shareholding in ZU. ZU is a 70% owned by a company called TU. This means who is having significant influence, not you, you. If that company is subsidiary of any other company, so they will not listen to you. You will not be influencing decision making. They will outweigh your decision because they are having more power. So this is not associate because you lost significant influence. Number three, a 25% shareholding in ZV and TN have also got an arrangement with other shareholder allowing them access to 55% of the voting right in a TN. So on that base, you are having control because now you are having 55% influence. So this is also not associate. So option A is correct answer. Number two, please. Which two of the following issues would require adjustment in a consolidated statement of financial position? Balance of from the parent to associate, cash in a transit from the associate to parent, unrealized profit relating to goods sold from the associate to the parent, unrealized profit relating to goods sold from associate to parent. So there is needed adjustment in consolidated retained earning, even in cost of sales, even in the asset. So where in consolidated financial statements, whether there is any adjustment required or not. So for this, adjustment is required.
Simple financial position is unrealized profit parent is settled.
Unrealized profit relating to goods sold from the associate to the parent.
Here is associate is settled.
It's not asking about adjustment required in asset or not. They are asking about consolidated statement of financial position. So in retained earnings required. In consolidated inventory, adjustment is required. The value of the associate being impaired at the end of the year. They ask about two options. Number three, please. You need to calculate the amount. Value of investment in associate, asset value you need to calculate. Does net assets include share capital, retained earnings? If they have been increased, increased to what? Profit. If they decrease, decrease to what? Loss. Is required. You need to calculate asset value. So cost of investment, in that we need to add profit share. From that, we need to deduct impairment and we need to deduct unrealized profit if parent source a subsidiary. So what is your cost of investment? That is 350. What is your profit share? At the date of acquisition, net assets were 700,000. Now net assets have moved towards 750. So 50 is a total profit and your profit share is 30%. So 15 should be added. Is there any impairment? No. Unrealized profit. Parent sold goods to associate. Yes, we need to deduct. How much they sold? They sold 80,000. Margin is at 25%. So total unrealized profit in 80,000 is 20. Half of the goods are remaining. So divided by 2, 10. What is your percentage? 30%. What is your percentage? 30%. What's that? 3. That you need to deduct. Because what you will receive from this profit in retained earning, 30%, not the full. That you need to limit it. What's the value? So 362,000 is the answer. So the same treatment with unrealized profit in subsidiary as well. Is that? Okay, number 4, please. Number 4. What is the share of profit of associate to be included in the consolidated statement of profit or loss for the year ended 31st December 20x2? What is share of profit that need to be consolidated? Is the share of profit of associate to be included in the consolidated statement of profit or loss for the year ended 31st December? On 1st January 20x1, P purchased 30% of share in A for 600,000. At this date, A's net assets stood at 400,000. When? 2 years back. At 31st December 20x2, A has net assets of 600,000. Mean there is a change of 200,000, but that is relating to past 2 years, not 1 year. A made a profit in the current year of 80,000. This is current year profit that should be added. Since acquisition, P investment in A has been impaired by 25,000. Of these, 10,000 relate to the current year. So profit share out of this 80,000, how much is your?
20%.
What is that? 24,000. Is there any impairment relating to this investment only? Yes. How much is that?
10,000.
10,000. So net share will be 14,000. Number 5, please. Number 5, please. We need to calculate consolidated. What is the profit attributable to parent shareholders in the consolidated statement of profit or loss for the year ended? Mean what will be the adjustment in consolidated retained earning? What will be the adjustment in consolidated retained earning? On 1st July 20x1, we purchased 90% of shares in subsidiary S and 40% of the shares in associate A. Extract from the statement of profit or loss for the year ending 31st December 20x1. Year end is 31st December when you acquire on 1st July. 6 months. And profit before tax profit for the year subsidiaries having a loss of 60. During the year, goodwill in subsidiary has been impaired by 10,000. The non-controlling interest is valued using the fair value method. This means impairment we need to incorporate. So what is the parent profit? That is 120. S profit share is having the 60 negative. So 60 negative into what? 80%, 90%? 90% into 6 by 12. How much? 27 negative. A profit share. How much A is profit? 70 into 40% into 6 by 12. And fair value method. So we need to adjust impairment of goodwill as well because it's relating to a subsidiary. How much is that? 10,000. So 10, but our share is what? 90%. So 9 should be deducted. What is the value?
$98.
Is that? They are measuring non-controlling interest on fair value. If on fair value, we need to deduct a subsidiary impairment of goodwill from non-controlling interest as well as consolidated retained earning. If that is calculated on a proportion of net asset basis, then we will not deduct this impairment. Is that? Shall we move forward? This chapter completed now. So let's discuss a small chapter. Chapter 23. Employability and technology skill.
What's the questions come from?
Only MCQ. You know about Microsoft Word.
Yeah.
You know about Microsoft Excel. You know about Microsoft PowerPoint as well. So there are 5 advantages of each and 2 disadvantages of each are given in this chapter. And they might ask any MCQ. Maximum 1 MCQ. Even that can be solved by using common sense. If we are using Microsoft Office. Obviously, to practice paper, we are using Microsoft Office. For theory paper, we are writing in Word. For calculation paper, we are practicing in Excel. In almost every paper of ACCA, they have included this chapter, employability and technology skills. Why? Because after qualifying ACCA, we'll be moving towards practical field. Now, every company is using what software? So you should be having practice, familiarity to use the software. That's why they have moved all the paper from paper-based to computerized. So that you should be aware about Microsoft Excel, Microsoft Word. So what we need to do in this chapter? Word processor. What are the advantages of word processor? It is easier to continue typing without entering new cells or becoming concerned about cell width. Mean as compared to Excel, what is the advantage? Mean we can insert text anywhere, just moving the cursor over there. Answer can be more easily split into paragraphs to make them more visually appealing and easier to mark. Mean we can show things separately. In Excel, you need to show things in different cells. Bullet points can be used to present a list, mean we can use bullet point signs. Text can be easily aligned and justified. You can align center, left, right, justified. Superscript and subscript can be easily added to express terms such as for part 2, for example. I mean, we can use different formulas. We can use a heading a little bit bigger, the other material shorter, the further notes shorter, like that. But there are disadvantages. It cannot automatically perform calculation because there is no formula bar as compared to Excel. Numerical tables can be difficult to label and align because we need to insert a table, then putting figures, then performing manual calculation. So this is the issue. And now what is a spreadsheet? Microsoft Excel. What are the advantages? This can quickly and easily perform calculation, for example, using the sums of part totals or formula calculation. Data within a tables can be easily aligned. Shortcuts icons can be used to quickly round figures, changes numbers to percentage, etc. Tables can easily and quickly be copied when calculation need to be reperformed. We can copy same data, even same formula to other cells as well. And column width can be adjusted to the label length. But there are disadvantages. Text will carry over beyond one cell and may go across and beyond the page width, making answer difficult to follow. Bullet points are difficult to use. And slides mean Microsoft PowerPoint. What are the advantages? Key messages are easier to see because on one slide we only write 1-2 lines. So key messages we only write, we don't write too much detail. Too much detail, we use speaker notes under the slides.
In which,
Just general.
okay.
Tables can be easily added. Speaker notes can be added for the details. Bullet points can be used to provide a list. And titles can be given more prominence. But there are disadvantages. There is limited space and ability to contain detail outside the speaker notes. Mean we cannot include too much detail in PowerPoints. It cannot automatically perform calculation. But PowerPoint cannot perform calculation. It's saying chapter finish. There is no question. Let's take a break. After break, we will cover next chapter 21. That's the last one.